If you have ever felt like your money is disappearing faster than it should, there is a reason. And ironically, it is the same reason a simple $35 a week habit can grow into more income than many full-time jobs. Time works against your paycheck, but it works for your investments. Once you understand that connection, everything else finally makes sense. In this video, I am going to show you exactly what that means, how it affects your paycheck, and how weekly investing turns it around in your favor. We will walk through real inflation pressure, how compounding works underneath all the chaos, and the list of Fidelity funds that keep growing even when the economy feels unpredictable. And at the end, I will show you a Fidelity index portfolio that can turn a $35 weekly investment into a portfolio worth close to $1 million that pays over $8,000 a month. But first, let us understand why weekly investing works better than one-time deposits in the real world. Most people hesitate with weekly investing because the amount feels too small to make a difference. $5 or $10 does not look like it could change anything. But that hesitation usually comes from the financial pressure people are already dealing with every single day. When your environment gets more expensive faster than your paycheck grows, consistency, not size, becomes the thing that quietly works in your favor. You can see it clearly with something as basic as food. Since the year 2020, food prices climbed 3.45%, then 3.94%, then jumped a painful 9.95% in 2022. Prices slowed slightly to 5.76% in 2023, and then moved to 2.45% by early 2025. Put simply, the $20 of groceries you bought in 2020 now costs around $25.32 today. That is not a statistic you forget because you feel it every time you shop. At the same time, borrowing money has gotten noticeably more expensive. The Federal Reserve data shows interest rates rising significantly from near zero in 2020 to about 4.09% recently. This makes mortgages, car loans, and credit cards feel heavier month after month. And while costs rise quickly, wages have not kept up. Most wage trackers show year-over-year pay growth, sitting around 3.8%. That is barely keeping up with short-term inflation and nowhere close to the total rise in prices we have seen over the last 5 years. Then there is the stock market. The long-term crash timeline highlights every major drop from the Great Depression to the dot-com collapse, the 2008 financial crisis, the COVID crash, and the inflation-driven decline of 2022. These moments always feel frightening in real time, but the charts make something else very clear. Every crash has eventually recovered, and the long-term trend still moves upward. Historical return data research consistently puts long-term market returns around 10 to 11% per year, including dividends. And this is why weekly investing is so powerful. You do not have to predict inflation, call market tops, or time the dips. If prices rise, your weekly deposit still goes in. If they fall, you buy more at cheaper prices. If the market rebounds, you benefit automatically. In a world that constantly shifts, that steady little habit becomes one of the few financial moves you can rely on. This is where the title of this video connects directly to real life. Because when the average paycheck grows around 3 to 4% a year, but a long-term portfolio often grows 2 to 3 times faster, your investments begin to build towards something your salary can never reach. Eventually, you can reach levels like $8,000 a month in passive income if you stay consistent long enough. When you look at those numbers, it becomes clear why long-term habits matter. Even tiny weekly amounts can create a snowball effect far bigger than you would expect. The snowball effect becomes clear when you look at how even small weekly investing behaves in the first few years. Imagine someone putting in $20 every week. That is $1,040 per year. An amount so small most people barely think about it. In year 1, the contribution is $1,040. With normal market growth and reinvested dividends, the balance starts to move a little bit. Nothing dramatic yet, but the base of the snowball is forming. By year 3, total contributions reach $3,120. With dividends reinvested and those early deposits getting time to grow, the balance could sit around $3,750. That extra amount, the part that did not come from your own pocket, is the snowball starting to build. By year 5, total contributions reach $5,200, but the account may be closer to $6,850. Now, the snowball has real weight. Each weekly deposit lands on a larger foundation. Every dividend buys more small pieces of ownership that create even more dividends. The first 5 years do not look explosive, but they build the groundwork that makes long-term growth possible. Understanding how that snowball forms is only half the story, because the mindset behind it matters just as much. Most people do not struggle with weekly investing because it is complicated. They struggle because the early results feel too small to take seriously. You put in $20, your balance moves a little, and your brain instantly wants to judge the progress. We are wired to expect quick wins. So when growth looks slow, it is easy to assume it is not working. We also react emotionally to short-term market noise. A sudden drop feels alarming. A recession headline feels like a warning. A volatile week feels like a sign to pause. But these reactions come from linear thinking, expecting the market to move in neat, predictable lines. In reality, compounding builds in curves. Markets rise, fall, and shake around on the way up. None of that shows up clearly in the early stages. The real mindset shift happens when you stop measuring success week by week and start measuring it by consistency. Instead of asking if this is growing fast enough, the question becomes, did I invest this week? That small shift removes the pressure to see instant progress and replaces it with a routine you can actually control. That consistency is what eventually allows your portfolio to grow bigger than your paycheck. Not because you outsmarted the market, but because you stayed steady long enough to let compounding do the heavy lifting. And once that mindset is in place, choosing the right investments becomes a lot easier. Choosing long-term investments becomes much easier when you understand what truly makes something worth holding. Instead of searching for the perfect pick, it is far more effective to look for a set of qualities that create stability and long-term growth. These criteria are exactly why the Fidelity funds in this portfolio work so well together. The first is diversification, which simply means owning a large number of companies instead of relying on just a few. When your portfolio holds hundreds or even thousands of businesses, no single failure can derail your progress. One company can struggle, another can shine, and overall your growth stays steady. Broad index funds handle this automatically. You get wide coverage without the stress of choosing winners. The second is broad exposure, which is different from diversification. Exposure is about what kinds of companies you own. Markets rotate. Some years large caps lead, some years mid caps take over, and some years sustainable companies outperform traditional sectors. A strong, long-term portfolio spreads exposure across company sizes, sectors, and styles, so you stay balanced no matter which area is leading. Next is real historical performance. You want investments backed by companies that have grown their earnings and strengthened their fundamentals over the years, not hype circles. Dividend growth is another key ingredient. When companies raise their dividends yearly, those increasing payouts buy more shares and make the compounding loop stronger. And finally, low fees matter. Even small fees add up over decades. Low and zero-fee funds keep more of your returns working for you. When you put all these criteria together, you end up with a portfolio built to handle downturns and capture long-term growth. This is where these 5 Fidelity funds start to stand out. Each one checks the boxes you want, and together they cover everything a solid portfolio needs. The first one is FZROX, the Fidelity Zero Total Market Index Fund. This is the core of your portfolio. It is a simple broad market fund that owns large, mid, and small cap companies across every major United States sector. Its purpose is straightforward. Track the entire market with zero management fees. That alone makes it a strong foundation. It currently yields 1.04%, grows its dividends at 7.55% per year, and has delivered an impressive 13.5% annual price appreciation. FZROX lays the groundwork by covering the full market and building steady growth. Then there is FSMDX, the Fidelity Mid-Cap Index Fund. Instead of focusing on the biggest companies, this fund invests in mid-size businesses that are stable enough to be reliable, but still small enough to grow quickly. It typically holds around 300 companies spread across tech, industrials, consumer sectors, and finance. It yields 2.42% and has a fast 17.21% dividend growth rate. FSMDX adds the expansion phase of the market, which includes companies that are still climbing. FITLX, the Fidelity United States Sustainability Index Fund, gives the portfolio a modern edge. It invests in companies screened for strong environmental and social practices. It yields 1.14%, grows dividends at 13.74%, and delivers 13.06% annual appreciation. It adds long-term resilience and growth from sectors that have shown strong momentum. FGRIX, the Fidelity Growth and Income Portfolio, brings balance. It invests mostly in high-quality large-cap companies with stable earnings, giving you a mix of reliable dividend payers and consistent growers. The numbers show a 3.13% yield and a very strong 19.68% dividend growth rate. It supports the portfolio by lifting both income and growth at the same time. Finally, FDGFX, the Fidelity Dividend Growth Fund, is the income stabilizer. It focuses on companies with long histories of raising dividends and strong financial fundamentals. It leans towards safety and consistency. FDGFX yields 3.2% and grows dividends at 18.03%. Its job is to strengthen the compounding of dividend income year after year. The next step is to calculate the portfolio metrics. We list the yields of each of the 5 funds. When we average them together, we arrive at an average portfolio dividend yield of 2.19%. Using the same method, this portfolio gives you a 15.24% average dividend growth rate and an 8.98% average annual share price appreciation. Together, these numbers show a portfolio that not only increases its value, but also increases what it pays you over time. So let us look at Josh's example. He is contributing $5 per day, which adds up to $35 per week. By the end of year 1, Josh's total contributions would be about $1,825. By year 10, the portfolio is projected to reach $32,000 with reinvested dividends starting to build real momentum. By year 20, Josh would have contributed $36,500 in total. But the long-term compounding will push his portfolio to about $160,000, generating nearly $9,000 per year in dividends. The final decade is where compounding really shows its strength. By year 30, Josh's portfolio is projected to reach $942,000. This pays around $98,000 per year, or about $8,000 every month in dividends alone. Over those 3 decades, he will have contributed a total of $54,750 out of his own pocket. But his portfolio multiplied it 17 times over. Out of that future $942,000, almost $887,000 was created entirely by compounding and market growth. That means the vast majority of Josh's future wealth did not come from what he paid in. It came from the portfolio working for him. And that is the point where his investments will earn more than many full-time jobs. All because he stayed consistent with a tiny daily amount. If you could only invest in one index fund that has the potential to turn $10 into a multi-million-dollar portfolio, check out my next video to find out which one it is.